All right. Hello and welcome back. David Kinder here, registered financial consultant, charter life underwriter with my co hosts Kurt Gibbs and Mike Moffat. Hey, I finally put that thing together here in the past few days. What did you guys think of that?
Awesome. I like it.
Yeah, we've gotten all fancy now. We have a real intro and everything. What do you know?
It's like we're going to become legit. Like someone's going to think we're actually serious about this thing, you know? Uh, we're not just going live and talking. Hey, we're official now. We got, what is it called? A title? I forgot what it's called. Whatever. So, anyway, today I didn't really have much of a topic, but I was talking to another agent this past week, and it reminded me of something that was in the news just not too long ago. And this agent was telling me of how they got involved in something similar. It's not this, but something similar, and they're being investigated by the SEC and stuff like that. And apparently, they're being accused of being a Ponzi scheme. Like, oh crap! It's not good for us as agents to ever be involved in anything, agents and advisors to be involved in anything that can put any kind of damper on the trust we're trying to elicit from the consumer and from the client. We're in the trust business, and I'm not talking about living trust. We're in the fact that we want consumers to trust us, trust our judgment, trust our professional expertise. And then when these things happen, it's a damper on the entire industry. And so I wanted to kind of talk about it. How can consumers protect themselves, and more importantly, agents? Let's make sure we can protect ourselves to make sure that we're not doing anything that can end up being a problem. So first, I want to share. This was an ad that was shared. Well, I shared it actually in my Facebook group, saying, "Does anybody know what the heck this is?" And this is, you know, it's just one of those things on Facebook, and sometimes you never know what social media is going to turn out, right? And it says, "This is not a fake post. Our company," and I blocked it out on purpose, "has been invited to share this great opportunity. Those that are worried about their 401k, 403b, TSP, Teacher Savings Plan, and IRAs losing money. That's not losing money. That's loosing money. That's like righty tighty, lefty loosey. Yeah, totally. Misspellings is a red flag right there, just to say. Um, we have a guaranteed 15% return every year for 10 years. Backed by Lloyd's of London Insurance Company, founded in 1688, Redbridge Insurance, whoever they are, protected insured up to $10 million. And then he gives a case study. One of my clients is putting in $180,000 in 30 days. He will start receiving, I don't know what that ampersand is doing there, but receiving $22.50 a month for 10 years. His original principal of $180,000 will never change. At the end of 10 years, he will have $180,000. He would have received $270,000 of interest, minimum $50,000. Message below info to schedule your consultation. I mean, it sounds too good to be true, and what you'll find out is that it was. Um, this was earlier this year, so let's just say it was about 6 months ago. So we're recording this October 2024. If it was 6 months ago, that would have been what, April? Right around tax time, sounds about right. Interest rates were right around 5%. Generally speaking, for CDs and stuff like that, and to be able to offer 15%, it's like, that's a nice number. How? How can they possibly do that? And we had all kinds of conversation and debate of how could they possibly do this? And basically, it's not guaranteed the way that they talked about this. We're trying to figure out, if this was legal, what would it look like? And all of that turned out to be all for naught because it didn't matter. But I'm going to share real quick because Tracy Lounsbury, good contributor, pretty analytical guy. He said, let me guess, it was, and he mentioned a big company that does a whole lot of recruiting, possibly, and he talked about the head guy. Now, I'm not calling anybody out because I've already seen someone else getting lawsuits, cease and desist, and stuff like that. I'm not going to call anybody out. But Tracy, I responded, Tracy, that wasn't the name. But apparently, Next Level Holdings, which is mentioned in the article I'll bring up here, targets that company's agents, and the person he mentioned is one of the spearheaders. Okay. I trust that was true. Don't know, but sometimes it's interesting to see who do these guys go for to market these things. And it was a problem. It was a big problem. And we finally figured it out that it was a problem when the Wall Street Journal got this out. Jason Zweig, or Zweig, however you say his name, and he is not my favorite columnist by any means, but he wrote about this. When interest rates go down, the hucksters spring up, and an investment advisory firm was promoting guaranteed annual yields of up to 17.1% until our columnists started asking questions, and the drama starts to unfold. Now, let me ask you guys here because I don't want to do a monologue. Um, what did you think? I'm sure you've seen this one or other things like it. What are your thoughts? What are some of the things that we as agents, let alone consumers, what should we be asking? How should we be getting clarity on some of this stuff?
Well, I'll say this. It seems to me that the more and more we have the ability to have social media and the different reaches, that we're seeing more and more of these scams that are just really prevalent about with anything that's out there, from a marketing stance to guarantees that they want to promise you the world from a marketing point of view, or whether it's
Yeah.
from a product stance like this right here. And you have to I think first of all you really have to do your due diligence and do as much fact finding as you can. And to some degree, I think that's very well screened and very well hidden for the most part when some of these elaborate schemes are developed. And it just shows you how crafty some people can be and create, whether it be a product or a message or whatever the case may be, to really scam not just agents, but scam potential clients as well. It's just one of those things you need to check with your state and make sure that your products you're using are covered with E&O and things like that in the event of anything that could possibly happen. But for the most part, just like what was showing us here with the spelling and the hypothetical numbers that just don't they just don't look good, and that should be a red flag for most people, and hopefully it is.
Yeah, well,
Yeah, it doesn't pass the smell test.
Yeah, good
It's
way to
like
put it.
something's not quite right, and unless we could substantiate it, we've got to stay away. Um, and unfortunately, I think like Tracy was trying to kind of pointing out, and I didn't show the poster there, but sometimes there are agents who say, if I can sell it with or without a license, let me know, and they'll sell anything. And I think that's a big problem, um, especially because, well, I know that when you have securities licensing, if you're selling something that the firm does not approve, if it's not on their menu, they call it selling away. And when you're selling away, obviously they want to keep all the business in house wherever possible. And unless it's disclosed to that firm, you're selling away, which means obviously they're not getting their commission override either. So let's bring that out. They're not getting compensated for you selling this other stuff. But in the same time, they want to make sure that they're supervising everything that you're offering. Now, insurance agents, especially when we're independent insurance agents, there is no supervisory other than our regulators, right? The state primarily, and whichever states that we're doing business in with in terms of other clients where they're located. It's up to us. We've got to be more diligent on those things. And so, and you mentioned it, Kurt, and this is the first thing I'm going to bring up right now. My best recommendation for agents and advisors to keep you out of trouble is to only sell and offer what you're licensed to sell and what your professional liability insurance covers. If you're going outside of that, you'd better be pretty sure what you're doing. Now, there's a couple of agents I know that they sell like tangibles, such as gold and silver coins, right? And I don't see anything wrong with that as long as you can verify that those coins are actually being delivered. As long as you can actually follow through on it, I see nothing wrong with that. Crypto. Oh God, when crypto first came, crypto is still kind of a scam in my opinion. Although it's not necessarily a scam product, but man, is it marketed in such the scammiest ways. I get all kinds of private messages and stuff. Hey, we're offering this new thing. I don't care. It's so scammy in and of itself. That doesn't mean that the Bitcoin's a scam. Bitcoin's highly speculative. It could go up and it could go down at a whim. But still, it's
Yeah,
just it.
you're right, and to something that just kind of, got me thinking about something else. And you're not hearing so much about it, as of late, unless it's, you know, on the web, and I'm not, really focused at trying to find it or locate it. But
Right.
the push for the investing, or the accredited investor, I think is the way a lot of things were worded in the oil market, was a big deal. Back 5, 6, 7 years ago, everyone was talking about what was going on in the West Texas oil, and how you could you could get involved in the oil market, and make these crazy returns. And maybe that's still out there. Maybe that's a legitimate alternative investment, if you will, to make a return. But from the products that we see on a day-to-day basis, I think that, like you say, if it's not passing that smell test, then there's obvious reason for concern, and it's something that you should find out as much as possible as you can, and take a deep breath, and look at it, and maybe come back to it. Not something that from an agent perspective, I think some of these guys and ladies out there that look at some of these opportunities, if you will, like this, at trying to find that big commission, so to speak, that maybe pays them more, and kind of throws caution to the wind, and doesn't do as much due diligence as they should to protect themselves, and not just themselves, but protect their client as well.
Well, and so along those lines, sometimes I think agents want to be as comprehensive as possible without obtaining the other licensing, which I can understand that. I don't want to obtain the other licensing, but at the same time, don't skirt the regulations. Don't try to do the shortcuts. And some of this stuff is too much of a shortcut, and it's going to bite you and probably the client in the ass if something happens here. And the last thing we need to see is a client that gives you every penny they've got into something. And unless the client can afford to lose it all, I wouldn't touch this stuff. I wouldn't touch it anyway. But something like this, assuming it was legitimate. I mean, crypto, we've determined crypto is legitimate, but I wouldn't tell people to put more than, what was it Tom Hegna says, maybe 1% of someone's net worth into possibly into crypto. I mean, you got to put an amount where if it goes away down to zero, it does not hurt you. Yet if it grows, great, all power to you. And that's the legitimate stuff. The illegitimate stuff, oh my gosh. I mean, can we as an industry and as professionals afford the scandal? I don't want when someone finally Googles my name to say, I wonder if this David Kinder guy is worth working with. And they Google it and they find my name, let alone a tied in to some of the stuff. Who knows what would happen? And quite frankly, I'm sure some people would love that scandal to get out there.
And
I
it's
don't need
amazing.
that.
It's amazing how well designed some of these scams and these schemes are put together, and how it on the surface it's going to check every box. It's just some crafty criminals out there.
Yeah, and
Yeah.
we could think back to the movie Boiler Room, and that was a 24-year-old movie. And what did Boiler Room do? The one guy, Seth Davis, finally he goes beneath the surface to do a little research on the stocks he's hawking, figuring out why are they paying so much high commission. It's like, oh, that's because these companies don't exist. And figuring out that it's its own scam in and of itself, which is why they market manipulate and all that other stuff. Of course,
And this kind of gets off on a different quadrant with what we're kind of talking about to a degree. But just like the conversations we've had in the past about IUL and the illustrations of IUL, IUL is not a 10% rate of return,
right.
product to illustrate, and it should never be marketed that way, or sold to a client that way, that that makes them think that they're going to get something out there that's never going to be possible. Yeah, 1 year returns, all that kind of stuff with S&P. I get that, but don't sell the average, quote unquote, of 10% in your IUL. Yeah. It's not going to happen.
Right, exactly. So going through here, Jason Zwig of the Wall Street Journal goes through a lot of things here. So first he talks about, here's the risk-free rate at the time, which was lowest treasury bills and money market funds were yielding about 5%. And Federal Reserve was expected to lower interest rates. And of course they did recently, about half a point. investors need to be on your guard. And so this firm, they call it Yield Wealth, and they were offering that 10-year term deposits offering annual yields up to 17.1%, which is just out of this world. Um, even before 2008, anybody was telling anything more than 10% a year, I mean, it really just makes you cringe. Like, how could you possibly deliver on that? And high yield bond funds about 7%. So, and that, again, we're guaranteed up to 10 million in insurance coverage through a network, including Lloyd's of London. So we know it directly ties to the first thing we talked about, bringing up at the beginning here. So colossal yields without the risk. Any interest you earn is locked in and can't be lost. You can lock in 15% APY in perpetuity. I'm like, that is just, it would be available forever. I mean, come on. Who's going to believe this? But it sounds so good. So, and they're claiming to be insured up to $2 million by FDIC. I mean, so many things. I mean, on the surface, it's like, this sounds too good. Why am I not hearing from anywhere else? Why am I not hearing about it from JP Morgan Chase? Why am I not hearing about it from some of the biggest top money managers? Why am I hearing about it from this? I called it a faceless name on Facebook because it was essentially faceless. Now at the time, and by the way, I think FDIC coverage might have changed. I saw something else from a credible source, so I'm not going to comment on that. But FDIC deposit insurance is generally limited to $250,000 per depositor per institution. And then if you have different titling and things, there's ways to get your FDIC coverage even higher. So if you have a joint account, that's a separate FDIC coverage compared to an individual account. If you have a trust account, that's another set of FDIC coverage. There's different ways to structure that. But if the entity isn't a bank, it can't market FDIC coverage. That's one thing that we talk about sometimes as far as insurance contracts. Insurance contracts are not covered by FDIC or NCOA, National Credit Union Administration. They're not covered by that. It's better. It's insurance by actual insurance companies. We're not using fractional reserves. We have 100% legal reserves. But aside from that, yeah, we cannot talk about the fact that it's FDIC insured because it's not. So whatever this program is, they're trying to make it way too rich as far as the guarantees and the return. Doesn't work like that. I mean, we've got to ask, what is the current risk-free rate for a given period of time? And then why is this so much higher? Why is that? How is that possible? Now, here's what's interesting is that then we got into the guy behind it. Kenneth Boyle said these products were never launched. Yield Wealth has now been dissolved without ever taking in funds. I hope they never took in funds because they were obviously perpetrating a scam here. Part of a testing phase. I think he's covering his ass here. But he says Yield Wealth products were never live, meaning no investors ever bought them. There were testimonials from people who've invested millions in its high yield products, including Carol, a retired plastic surgeon who supposedly invested $3.24 million in a 10-year deposit yielding 9%. I thought it was 17. Come on, 9? Come on, give me the higher number here. I mean, if you're going to perpetrate a scam, let's go all out here, Someone's got to teach them a little marketing here. Boyle says that website was only a placeholder and should be ignored. Sorry, if you have a website up and you got something in writing, nothing can be ignored. It will be admissible in court. You will be held liable for what's in print. Just crazy. So Boyle says Yield had cultivated solid relationships with leading providers built on merit and confidence in our strategic vision. Here's what's interesting. Lloyd's of London doesn't comment on specific policies or policyholders. Makes sense. Lloyd's of London is ultra private, ultra risk retention. Whatever they do things at a very different level. But what's interesting is that in April, Yield filed 2 of its term deposit offerings for sale under Regulation D, an SEC rule that permits private sales of securities with minimal disclosure. Now, Kurt, you mentioned this earlier regarding accredited or sophisticated investor. That means that this should have been only offered to an SEC accredited or sophisticated investor, not the general public. Because if it's a private offering, it's literally not a publicly traded offering. So if it's not publicly traded, if it's not available to the public, by default, it's private, and it should have had far more disclosure required, and basically, and even the disclosure says this is only available to accredited investors or sophisticated, whichever term applies. And I know there's the two different ones.
Yeah, and I'm kind of probably speaking out of turn a little bit here when I say this. I'm not very well versed in what is defined as an accredited investor, but I feel like there's a good bit of proper paperwork that has to be in order uh, to meet those qualifications from an accredited stance. I mean, there's going to be some background check as far as what you have available in assets, and you're going to have to prove that and disclose that and have a paper trail that supports that.
Right. Yeah. So you've got to have a significant net worth, and I don't mean huge net worth, but I think you have to have an income, either an income of 250,000 plus, a net worth of $1 million plus. That is not including your home equity, and
Yeah,
probably not including your retirement plans. I think it has to be all separate.
There's a huge liquidity number that has to be figured into that. I'm not sure what that is for the most part, but it's probably, I would assume it's north of 250 in any circumstance.
Yeah, absolutely, absolutely. So when that, just by the fact that the ad when we first started off said 180,000, I'm like, well, that had better be on top of everything else you've got going on. Minimum 50,000 investment. Come on, they're not going to offer this at 50,000. You've got to have far more money, and yeah, you've got to be an SEC accredited or sophisticated. And I know there's a differentiation, and I don't remember what it is.
David, you mentioned just a few minutes ago about crypto again. It seems as of late we're seeing maybe it's just not in the feed that I click on, and I don't spend a whole lot of time in that space on a given day. But it seems to me that's there's been somewhat of a cooling period, I guess you would say, that's going on
for about a year.
I
haven't seen a whole lot ever since. I know Bitcoin took a dive. And I don't know. I don't track it. I'm not going to look at it. It's interesting on occasion if it shows up in my news feed. Like, okay, it came back up. But the push for crypto has not been as strong. I don't get the same kind of messages anymore about all that garbage. Obviously that's my bias showing that I think it's garbage. I don't like it. What's interesting is that all these people want all these great returns, and returns is part of it. But imagine if you can have the greatest tax exempt asset and you don't have to worry about all that stuff. It's available.
You were taking the words out of just right out of my mouth. I was just about to come back with that. I mean, here we are talking about, the scams of the world. And there's so many that we don't have enough hours in the day to talk about, a tenth of them, but the one tried and true that's been around forever, as we've talked about in the past, is you want the solid guarantees. You want the A-rated carrier. You want them to pay when when they're supposed to. We've got 2, 3, 4, 5 of the best companies out there to work with on the guarantee side of things, and it's been under our noses for over 100 years and how to use it as far as the code goes, and so is the product. Some of these insurance companies are 100 plus years old with impeccable track records.
It's the greatest secret, depending on what our objectives are for that policy. Now, let's be clear. The return on life insurance sucks. But once we can see what else we can use it for, it's the greatest, most flexible asset that allows us to do all kinds of things for individuals, families, and businesses. Once we can get our head wrapped around that.
Yeah, I mean, we talk about it all the time, on and off the air is, where else can you take $1 and spend it as if it was $3? That's what we're talking about, being able to do. That's not a myth. That's not a hypothetical. That is how having your money in the right spot makes all the difference in the world. And rate of return is really, secondhand.
Which is beautiful when we're able to do that. So just going on with the investigation here, the author said he had a memorandum that says mega involves substantial risk. Stated the stated yields might not be achieved, and investors should be able to withstand a total loss of their investment. Crazy. They said they would be invested in multiple industries, including lucrative sectors of mining and rare minerals. By the way, life insurance is invested in all industries, just about. if we go to the ACLI's Facts of Life fact book, Facts About Life Insurance, they're invested in so many different things to get those decent returns back to the general investment account. So you want decent yields? The insurance companies might be able to help you with that. But apparently, with this yield model, the proposed investment strategy for its term deposits after portfolios run by a successful firm called Next Level Holdings. And Tracy mentioned that one. Who's Next Level? Claiming to offer fully insured and guaranteed investments with fixed rates of return up to 15.5% per year. Next Level is run by a man named Paul Reagan. He has said he generates big profits taking advantage of differences in the price of gold across global markets. We're talking about arbitrage. Arbitration is where they're going. Arbitration is court appearances. Freudian slip, maybe, but it's still, I mean, arbitrage. They're trying to, can you predictably do that on a regular, ongoing basis? I mean, in a way, that's also like the foreign exchange currencies and finding those pricing differences. Those things last for seconds, if that. It's hard to do that reliably and predictably. Boyle says yield obtained debt financing from Next Level, and its website includes some products that Reagan had recommended featuring. Anyway, this part was interesting, though, which is great for the journalism here. After I asked Reagan about this, his LinkedIn page disappeared. Apparently, he said that he worked at Goldman Sachs. He later emailed me saying he regretted that profile contained inaccuracy. I did not work for Goldman Sachs, and I apologize for any confusion this may have caused. I'm like, because Goldman Sachs is a big name. Whether you like them or not, because they've been in the news for different things, but they're a valid name, been around for a long time. It's a prestigious name. But under the name Henry Paul Reagan Jr., Reagan was barred for life from the securities industry in 2004 for failing to respond to inquiries. Now, whatever the inquiries were, don't know. But allegedly, this is the inquiry. He was fined $60,000 by the Oregon State Securities Regulators for allegedly forging documents and stealing approximately $140,000 from an elderly customer with dementia. I mean, all the guy had to do was contest it and everything. Now, he might have been barred anyway, but he should have at least responded. Reagan says that he had been barred from the securities industry when he was young and foolish. No, that was criminal activity. You steal from an older lady with dementia? Come on. Then he tries to defend himself. You definitely don't have your facts straight. Then he regretfully confirmed that he was him. I concealed my full name because I deeply regret my past. Did not want to disclose a disbarment. I understand the importance of transparency. Sincerely apologize for not being forthcoming about this earlier. Want to clarify that neither Next Level Holdings, Yield, or Mr. Boyle were aware of this. I mean, this is a whole house of cards is just collapsing once you go in further in detail. They still, like this says, doesn't get Yield off the hook for promoting such high returns while implying that they were risk-free. Asked about this, Boyle says the term deposits went through multiple iterations, which led to some discrepancies. Yeah, how convenient that is. So at the end, if it sounds too good to be true, it not only probably is, it most definitely is. We've got to be on the lookout and guarding ourselves, especially for people who are concerned about getting higher returns. When you're getting into retirement, it can feel like I need every single penny that you need. And yet, so something like this could be very enticing. But we as advisors, we have to set proper expectations, help guide our clients to make sure that they're not falling prey to any of this stuff. These are a problem. And this is obviously not the only thing that's out there.
Yeah, I mean, this is surprisingly sinister. This is one of the extreme examples, probably, and there's probably worse ones, of course, but I mean, this is a pretty sinister thing. And just from a consumer protection standpoint, you got to think to yourself, how are they going to guarantee me 15 to 17% on anything? Where are they putting their money that they're getting at least that or more? Because no investment company, no insurance company, no company, period, is in business to lose money. So if they're going to guarantee you 15 to 17% or whatever wild number they want to throw out there, where are they putting their money that they're able to get 50, 60, whatever the percentages that they need annually to support these kinds of returns? I mean, right there, that raises a red flag to me, because I don't know And I'm sure none of us here know any place that you can get those kind of returns on a guaranteed basis. And then the fact that they said, oh, that was just an error, nothing was really guaranteed, trying to back talk all of this stuff. I mean, I guess hopefully it's a good thing that nobody actually put money into this like they claim. But, had somebody, then we'd have a real problem. And then also on top of that, it says that they went on at the thing and towards the end of that article there, they said, oh, it was never guaranteed. But yet their headline was guaranteed. So it was just an outright scam to begin with. It's just wild. This is a very, very sinister, evil thing that was apparently about to happen to some people.
That could have easily been done. And here's the thing is that these companies cannot do this without costs. So they have to yield or create a higher return.
Right.
If we're talking about just the spread. So let's suppose they have to generate 20% each and every year in perpetuity to net for the client the 15 so that they can pocket the 5 because they can't do it for free. Something has to give. Now
that's the first red flag right there, right? Where is the insurance company or whatever company you're going through, the financial company, where are they putting their money that they're able to guarantee you 15%? Because they have to be getting more than that.
Has to, and that the people at the top, the people that are creating this firm and such, they've got to get paid very well, which means they've got to bring in everything, which to me it sounds like this might end up being a Ponzi scheme, which means sorry, Kurt, but which means that the earlier investors, they're the ones that are going to get anything, and the later investors, they're going to be sinking through everything because they're going to be paying the earlier ones, and that's the very definition of a Ponzi scheme. Right. And so it's a problem. And the thing is that with every Ponzi scheme, like Madoff, like whoever else, there's all kinds of things that are out there, eventually it's going to fall apart. And so when I talked with this agent in the last week or so, there was a time where he was also involved with Woodbridge Wealth, and they were determined to be a Ponzi scheme as well. So what we've got to look at is we got to apply, and it's going to sound wrong or sound rude, but the fact is you got to apply the common sense of the three-legged stool. If the client is going to win and the agent or the sales representative, whoever it is, if they're going to be well compensated, where's the money going to come from? We've got to figure out where it's all coming from. And if we can't figure that out, don't invest. Don't do it. And if as an agent, we're in the public trust business, and if we can't substantiate everything, don't ask anybody else. You've got to do your due diligence because the public is asking for help from us. They're looking to us for advice. They're looking to us to trust us to be able to get them the best returns, put their money in the safest, not necessarily safe, because if you're an advisor, you might put them into mutual funds and assets under management, stuff like that. And those have their certain risks, but those are more quantifiable. But if you're going to put something like this, you better be able to back up why you're recommending it, at least for at the time of sale. Now, sometimes things come falling apart later, and we can't always fault that. But you've got to make sure you do due diligence before you're offering anything to the public.
Right. And
I want to sleep well at night. I don't want to think that, I perpetrated a scam, which means I'm going to be, I don't need heartburn. I don't need ulcers. I don't need any health issues for putting people in harm's way. I felt bad enough in 2008 just with the mutual funds, and mutual funds went down 50%, and it was not my fault. I represented everything properly. Everything was properly disclosed. The market tanking was not my fault, yet I felt bad for them. And quite frankly, if you're the type of person that can't feel bad for a client, maybe that type of person should not be advising clients. We want clients to be in a good position and understanding the risks that they're taking on for the amount of money that they're entrusting with us to do whatever it is we're employing that money to do. But yeah, if you've got nerves of steel, good for you, but that's not me. I don't know. Call it. I'm a highly sensitive person, and that doesn't mean I go run off and crying. It just means that I feel bad when my clients feel bad, and I don't want to put them in any position where I might be the cause of that. That's my thoughts there.
Right.
Kurt, you had some background noise there. If you want to unmute, chime on in here.
Yeah, I'm a little in a different little situation this afternoon for the podcast. Had a little interruption there at a local coffee shop here, so sorry about that.
Kurt's sitting at his usual Starbucks, I'm sure.
Yeah, I got a little internet trouble at the home office there, so decided to venture out late in the afternoon to do the podcast today. So yeah, but good stuff. No, it's something we all need to be aware of. Once again, just do your homework. And Mike, you kind of summed it up really well, I think, with where's the money coming from? It's got to be good for everyone. And understand that everybody has to make money. It's got to be profitable, but within reason.
Right. And profit's not a dirty word. I feel like, a lot of times, especially in the insurance business, everybody is looking to pull one over on the insurance company, or why am I paying this premium? These companies are just making profits and this and that and the other thing. Well, profit isn't necessarily a dirty word. If you want the insurance company to be able to pay claims when you have a claim that needs to be paid, the insurance company has to be profitable, and they have to have enough money in reserves so that they can pay all of their claims if a catastrophic event happens. So just because the insurance company is profitable, that's not a bad thing. That's actually what you want as a consumer and as the end user. You want the insurance company to be solvent. You want them to be making a profit. Now, of course, there is some truth to the fact that you don't want to necessarily overpay either, right? So we have to temper that. But, it goes back to this whole thing where if this company is promising you 15, 17, whatever percentage it is, okay, maybe they found a way to guarantee themselves 20, 25%. Making a profit isn't a bad thing, but you have to go back to figuring out, well, how are they making this? Because let's face it, if I could put, money somewhere and guarantee myself 15 to 17% every single year, you'd have to be a clown not to do something like that. You can't get that in the market. You can't get that, guaranteed anywhere else. So, if it is a legitimate thing, you'd be pretty foolish not to do it. But then comes the question, well, how are they doing it? So, and if you can't figure that out, and if it doesn't make sense, which it doesn't, as we know, then that's where the issue comes. But I always go back to this thing where I feel like people get upset because insurance companies make a profit and make money. Well, you don't begrudge necessarily other institutions for making money when you want their products or things like that. So, and you still buy their goods and invest in them, buy their stock, etc. So, and in fact, if you are a stockholder in a company, you want them to be as profitable as possible so the stock goes up, right? So I think that there's a stigma about, this whole thing where insurance companies are making all this money. Well, I would hope that they are, because the time that I pay a claim, I want them to be able to have the funds and reserves to pay the claim. So I think we need to get away from that idea that, it's just all a scam and these insurance companies make so much money and, that's all that they do is profit.
I think a lot of that, in my opinion, comes from more of the property casualty industry of the insurance industry as opposed to the life insurance industry, in my opinion. Because with property casualty, will they pay your claim when you have a claim? And there's so many ways that insurance companies can get out of paying those claims. With life insurance and health insurance and such, well, health insurance is a whole nother issue. Let's not even go down that route. But with life insurance and disability, if you can prove that you have died, it's going to pay out as long as the policy is in force. Duh. That's all they need. There's a death certificate. If you're disabled, now they're going to have you evaluated to make sure, how much of disability. Then they'll figure out how much of it and all that stuff. But I think a lot of that really comes from more of the property casualty stuff. Because, here in California, we're having, and other places around the country, we're having crisis of premiums and such. And like they're raising those rates so high because of regulations and all the other stuff going on with that. I'm not even licensed in that area, so I'm only commenting from the news. But there's issues there.
You could certainly add term life insurance to that too, because you have all these BTID, buy term invested difference guys that talk about buying this quote cheap term insurance policy. Well, it's cheap for a reason because only 2 to 3% of these policies ever pay out, and if it's more than that, the company has, all these insurance companies risk becoming financially insolvent because they count on the fact that only 2 to 3% of these things pay out.
Right.
So,
Actuarial
I mean, if you want
assumption.
to talk about a profitable product, it's term life insurance. They're making bank way more than any whole life insurance product, because at least if you hold on to that and continue to pay they're guaranteed to pay the death claim at some point. I don't know anybody that's made it out of here alive. So,
Yeah.
right. So
No one has a lease on life, and and some people, anybody that thinks that they're going to get out without dying, look, even Christ died. He just wasn't dead for very long. Okay.
right.
I just got to throw that out there. Now, here's the thing about the insurance industry, though, for the life insurance side and annuities and such, because sometimes there are some almost outrageous opportunities out there, and I call them outrageous on purpose. So let's take, for example, and I think we can call them out by company name. Silac was a B-rated type of a company, and they were essentially buying business because of their ratings. They were offering some amazing living benefit riders that if you held on to the thing for like 10 or 20 years, 100,000 grew to like $4 million. And then it would pay out an income based on that benefit. Well, why could they do that? It's because their ratings were so low, they have to entice people through such, quite frankly, a gimmick. And that company, I think they're in receivership, or at least they've been in trouble. That much I know. I don't remember their status on that, but that company's in trouble. There's another one. I actually met the author of this book. Gary Schulte wrote The Fall of First Executive Life, the biggest insurance company failure of modern times still. And the thing about First Executive is that they did not invest their general investment account the same ways as everybody else. They invested primarily in junk bonds. And when junk bonds started to go down, or the risk of default increased, they weren't able to substantiate the illustrations of it. They were a AAA rated company back when we actually had AAA rated companies. And so their hubris took them down. And yet, if we were looking at things from a fiduciary standpoint, I'm using that word almost facetiously, but a fiduciary standpoint, you could have the highest rated company and it could still fail. Illustrations can be illusions. So what are we looking for now? We're looking for good companies with good illustrations. They just need to be good. They need to be decent. They don't need to be the absolute best, because if they're the best, and we'll talk about our mutual mentor, Tom will talk about the college pennant, right? You have people that are investing, that are illustrating the highest. The only place they can go is down. You have people that are illustrating the lowest, and all they can do is go up. And you got some that are right in the middle. And eventually it all comes down to about the same long term. That works. That's okay. All we got to do is manage our clients' expectations and such, and recommend good companies with good products. We don't need the absolute best. Okay, that was a diatribe there.
But so true.
Right. And so it goes back to this whole thing, I think, where if insurance companies, right, they're supposed to be more conservative generally, with the exception of maybe one or two, right? I mean, we use, at least within our group or club or hangout or whatever you want to call it, the companies that we use are 100 plus years old. They've been around forever. They're very conservative. They're not going to project illustrations that are insane, and they're not going to, they're going to be pretty close to what you're actually going to experience. Now, if you haven't, the problem that gets started here is, especially with an IUL, is where they're showing that you're going to get 8%, 6%, 7% every single year in these IULs in the illustration out into perpetuity. And that's just unrealistic. That doesn't happen. So maybe they're averaging that 6, 8%, whatever it is. But on these illustrations, they're showing that you're getting that every single year. And that's where agents get into problems, because they're showing these returns, assuming that you're getting something between 6 and 8% every single year with no zeros, So that's kind of where the illustrations fall off the tracks with an IUL. So The guaranteed column, right, is zero. It's probably never going to happen. You're probably never going to have an IUL for 30 years or whatever. And, it gets zero every year. That's unrealistic. The far right column, when you're looking at an illustration, is also unrealistic because that's showing, 6 to 8% every single year without fail into perpetuity. That won't happen. So, if you really want the middle column of an IUL of around 3 to 4%, that's probably more realistic. But even then, you've got to factor in that, again, that's every single year. So, there's still some, even with the middle column of the illustration, there's still some leeway there because it could be a little less or it could maybe be a little bit better than that. But if you're going to use a column for an illustration in the IUL, I would use the middle column. I think that's a pretty, at least safer column to show a client as, opposed to the far right column where it's showing the highest number you can show out into perpetuity.
Yeah, and just setting proper expectations and such. And so here's the thing is that the higher the promised number, the more I'm thinking you've got to be prepared to lose it all. Because there's something that just isn't quite right. And I forgot who said it, but I think most people would rather have the promise of the return of their money than the return on their money. And that's what I happen to like. I like being very conservative with that. It allows me to sleep at night as a professional, let alone helping clients to sleep at night. During whatever turbulent times, I love the principal protections that we can offer, knowing that they cannot just be protected against volatility, but they can take advantage of it depending on how they're structured. I'd much rather put people in a more conservative place than this other kind of risk, all because I think, these amateurs, I call them amateurs, they think that they can offer a higher return without having securities licensing. Sorry, guys, just don't go down that route. Do your homework. That doesn't mean all these things are scams, but believe me, you've got to know what you're getting into and be able to back it up. And quite frankly, if anybody is hearing about stuff, reach out to us. And of course, you can probably tell we're going to tell you to be cautious and probably not even go forward with it. But still, I'm always curious as to what's out there. And we'll probably just tell you if it's too good to be true, it probably is. Don't put anything more than you're comfortable of losing everything that you put in, if you're going to do it at all. And I probably wouldn't. And this is not a recommendation. This is basically saying if you're going to do it, be prepared to risk it all. Same thing with crypto, right? If you're going to put money in, you might lose it all. You just got to be comfortable with that kind of risk. And it sucks that this stuff is out there. But our job is to advocate for the consumer. Our job is to make sure that they're making informed decisions. And if I can help someone to avoid losing their entire life savings, that much the better. Any final thoughts, gentlemen?
I think we touched this one as well as we can lay hands on it.
I think we did too. We'll be back probably next week. If not in 2 weeks, we're going to have a book author come on. He's written a book on retirement, and so I'm looking forward to having him on. And I got some other things down the line. So we'll see what happens from there. But anyway, enjoy the closing music.
See you guys.